Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Pavitra Parekh and Sonal Bhutra is also here with us. Girls, it's Friday. So, where's the big smile? This has been such a long week, right?
It has been a long week. Budget, earnings, and of course, we've been,
Tracking the Adani episode.
Yes, so a lot is happening, of course, but thank God it's Friday.
Thank God it's Friday, but we also have a very packed Friday. There are a whole host of big companies that are due to post results.
SBI, ITC, Divi's Laboratory. The list is very long.
Exactly. So long time to go before.
But just a quick word on the markets then, before we tell you what's lined up on the show. Even as the Adani episode continues to roil the markets, Adani Enterprises is down 25%. Off from the low, because at one point of time, Adani Enterprises was down 35%. But across the board, you can see these stocks are still in the red. The damage appears to be contained because right now, the frontline indices are holding up in the green pretty okay. In fact, the Nifty and the Sensex are trying to inch up. The mid-caps are under severe pressure. The mid-cap index is down 1.2%. And the problem is also in the PSU banking index. So even as the private sector banks are holding up the Nifty banking index, the PSU banking index is under pressure, and the street is worried that if the situation worsens in the Adani groups, what will be the fallout on these individual PSU banks, which perhaps have lent to the Adani group, and that's where you are seeing a bit of pressure.
So in that case, SBI's earnings, very important today. Most importantly, the commentary coming in from there. Of course, we'll track all of that for you, but let us tell you what all is lined up on the show today. Stocks trade in a range. Mid-caps underperform, FMCGs and banks lead, while metals and energy drag advanced decline ratio in favor of declines.
Budget 2023 ended the tax advantage in market-linked debentures. We'll be joined by Feroz Aziz of Anand Rathi Wealth to understand the impact on distributors of such financial products.
And finally, we will also be joined by the managements of Eclax and Greenlam Industries to discuss the company's third quarter earnings.
We'll also get you key expectations from Big Boy, SBI and FMCG major ITC a little later on the show. All this and much more in the next 60 minutes.
Okay, as you can see, we've got a packed trading hour for you on this show. For the markets per se, let's just quickly take stock of some of the big movers which are holding up in the markets. Titan is your top Nifty sectoral gain individual mover. That's up close to about 4.5%. The management indicating that the month of January has seen good demand. That's a positive. And just yesterday, the stock had declined on the back of the margin miss. So there is that recovery that you are seeing, a rebound. CLSA said the recent decline is an attractive entry point. So Titan is currently the top gainer. Apart from that, it's followed by IndusInd Bank. That's higher by 2.2%. Remember, IndusInd Bank has an exposure to the Adani Group stocks. The stock has been under pressure. In fact, since the last 1 week, perhaps IndusInd Bank is down close to about 15%. But today it's rebounded. Also because what Ritu told us that the Hinduja Group is looking to invest 10,000 crore rupees in IndusInd Bank to increase their stake from 15 to 26%. But we've got a lot
in terms of earnings,
right?
of course, and earnings reactions as well, Reema. You know, while we are talking about the big picture, earnings expected from ITC, it was at a 52-week high yesterday. We have SBI, which is lined up today. From the broader markets, while the broader markets, as Reema pointed out, not doing so well, has been an underperformer today. We have a couple of these names which have seen a substantial decline. So ASH Kelkar reported weak set of numbers, that's down 13%. Welspun Corp is down 10%. We also have IG Petrochemicals, Voltam Transformers. So the list is long, of course, Pavitra, but we will be tracking that and analyzing that as well.
Oh, absolutely. And, you know, if we're talking about the markets, also take a look at the kind of cuts that have come through for the metal index. I mean, just today, it's down over 4%. This is on the Nifty metal. If you take a look for the year so far, we've seen an over 15% cut. So some of the larger names will be up for you, the likes of Hindalco, Tata Steel. I'm just naming a few, but, you know, pretty much that entire pack is under pressure. So we'll talk more about that. But, you know, like we were just mentioning to you a while ago, the key earnings to track today will be from State Bank of India. So Abhishek is joining us to tell us what we should really expect from the bank this time around. Abhishek?
Well, Pavitra, it could be the highest profit in a quarter that SBI has given, which may come in Q3 FY23. So the key things to watch is that the net interest margin will expand YOY, and quarter on quarter we have seen with other lenders, the yields have played out really well in terms of aiding the net interest margin. So analysts are expecting a 5 to 15 basis point improvement in net interest margin. Kotak Securities has estimated a loan growth of nearly 18% YOY and about 3% quarter on quarter, largely it may be driven by the retail portfolio. Now, Kotak Securities also estimates slippages to be around 7,500 crore, which is on the higher side, and this may be led by SME and the retail portfolio. Asset quality expected to improve. Gross NPA ratio as per ICICI Securities is estimated at 3.35% versus 3.52% quarter-on-quarter. So like Kotak Securities has estimated a higher slippages, need to watch out for the recovery and upgrades as well as the write-off in terms of, the gross NPA improvement. Management commentary with respect to growth outlook will be seen closely, and comments on exposure, to a large conglomerate or let's say Adani group will be seen closely. Watch out for the two key stress numbers, watch list, which is about 8,500 crores, and restructured book a little over 27,300 crores. How they move will be seen closely. Our poll suggests NII growth of nearly 21% YOY and about 5.3% sequentially. We are working with a profit growth of more than 61% YOY and about 2.5% sequentially. Back to you.
Thank you very much for that. Get into a break. We'll come back and discuss what's buzzing in the commodity space. Manisha Gupta joins in next.
Welcome back. You're still tuned into Trading Hour on CNBC TV18. For now, it is just a minor green tick on the Nifty that we are seeing. So around 10 points higher is what we have on the Nifty. We've come significantly off the day's high. Like you can see on your screen, the day's high was closer to around 17,715. So we've come almost 90 points off that level. But let's talk about the world of commodities as well. We have Manisha joining us, and today she's going to tell us about the move in copper prices. Manisha?
Thank you for that, Pavitra. Well, the strength in US dollar index seems to be weighing on across many of these commodities as well, but not copper, because we are still trading at around 7-month highs onto this one, with support coming in because of supply disruptions in the La Bambas mine in Peru, which accounts for 2% of global copper production, and we have seen much of those facilities and mines shut down. Peru actually is looking at the worst civil unrest in last 20 years, and 30% of copper production in Peru is expected to see some disruption coming in, and that has added premium to the prices there. And not just that, Chile as well has talked about lower production in 2023. Peru and Chile, between this, we see nearly 6 to 7% of global copper production. So at this point in time, both of these countries are talking about lower production. In 2023, Chile says that the production could decline by nearly 6%. And then the world's major producer in sense of copper is Southern Copper, which also says that they already have seen a decline in production in the previous year, down by nearly 6.5%. And this year as well, the production could see some hit. Now, the markets are looking at strong Chinese demand going forward. Copper also is a green metal, so the EV demand is expected to be quite strong as we step into the next quarter. So with all of these fundamentals in mind, there is constant support that we have seen continue for the commodity. They did see 12% of gains in the month of Jan, but for the week, we are down nearly 2.5% for copper. But from the lower levels, there is buying that has come back in yet again. Markets do watch out for the non-farm payroll data today, because the further direction and the movement in prices would come in from that.
Okay, all right, Manisha, thank you so much for joining us. So that's all about copper in the commodity segment. Time for a short break now. When we return, we'll be joined by the management of eClerx to discuss the company's third quarter earnings.
Back, let's get a corporate conversation going. eClerx is on our radar. The stock is up 2.5%. They've delivered a pretty good Q3 performance. Revenues have gone up by more than 3% on a quarter-on-quarter basis. Margins are down 30 basis points sequentially. To talk about the way forward, we're joined by the company's CFO, Nadadhur Srinivasan. Morning, and thanks so much for joining in. Can we first talk about your revenue growth? 3.2% on a quarter-on-quarter basis. Was there an impact on account of furloughs? Can you quantify that? And do you expect the furloughs to spill over into Q4?
Okay, thank you. Thank you firstly for having me. So I think we did pretty good in this quarter. 3.2% is very strong growth, and we are pretty happy with our performance. We are not an IT company, and therefore there was some, we do some IT work on the side, but it's not a primary driver of our revenue. So while there was some impact of furloughs, there was not a lot. What we expect for Q4, I mean, given the macroeconomic situation, we do expect some kind of moderation of demand for Q4 as well as for the rest of the year.
Okay, Mr. Srinivasan, when you said there was some impact of furloughs, can you quantify that for us? And about the macroeconomic situation as well, what does it do in terms of your revenue growth going forward as well? You had given a guidance of FY23 revenue growth will be in mid-teens. considering what we are seeing in Q4, do you think you will be able to achieve that?
Second question first. So I think we've already achieved what we said. I think we said double-digit growth between 12 and 15. I think we've already done that in 3 quarters. So I don't think that's going to be much of an issue. The furlough one is insignificant as far as we are concerned.
Okay, good morning, Mr. Srinivasan. You've already taken us through the revenue guidance, but on the margins, you had guided for 28 to 32%. Can you tell us if this still looks attainable to you? Because right now it's a little bit below that.
So our EBITDA guidance was for 28 to 32, and we are still in that range. And I expect that even in Q4, we should be able to stick to that level. Although we may be at the lower end of that 28 to 32 range.
Okay, so FY23 revenue guidance, you're holding on to 12 to 15%, and EBITDA margin guidance will now be at the lower end of your guided range of 28 to 32%. You started off by saying that you anticipate some moderation in growth in Q4 and the year ahead. Can you tell us what is it that you anticipate? What could next year look like?
So it's kind of difficult to predict, but the overall macroeconomic environment is so uncertain, with especially in our client geographies of Europe and North America, where most of our clients are. So it is kind of difficult to predict what the impact is going to be, but we do see that demand may not be as strong as what it used to be in the first 9 months of FY23 or even last year.
Okay, so give us a sense of how the deal wins have been in Q3 and what is the pipeline looking like, since we are talking about the demand weakness that you could possibly see. Have you seen any cancellations, so to say?
We have not seen cancellations, but we do see clients taking a lot more time to decide on how much they want to spend, when they want to spend, when they want the spend to start, and so on.
And what was the deal wins this quarter?
Actually, we don't release information or we don't disclose information on deal wins.
But I'm sure your investors would like to know now also, because your Q3 numbers are already out. Was it an increase versus Q2? Was it stable, flat, or did it see a decline?
I think year on year there has been an increase, which you can see reflected in the results. But we don't release specific information on deal wins.
But no cancellations at all, right?
Cancellations, no.
Okay.
Delays, yes.
Okay. We also noticed that your top 10 clients is down a little bit sequentially. Can you tell us what is the reason for that?
The top 10 clients are where we have a bouquet of services with them, including IT, including operations, including onshore. So there has been a little bit of drop on the onshore revenue with the top 10 clients. And, if clients are looking to cut costs, the onshore one tends to be higher cost and therefore easier to cut.
Will tech budgets be lower this year, 2023?
I'm sorry.
The tech budgets for your clients, do you anticipate a cut?
We do expect that it will be lower, yes.
By how much?
Difficult to say, 10 to 20%.
Oh, so would that mean that for you, revenues could be flat, low single digits for FY24? Because it's a very sharp budget cut of 10 to 20%, right?
So tech budgets, I would classify that in 2 buckets. One is discretionary spend, which is likely to see a cut. The other is run the bank kind of or run the business kind of spend, which may see a lower percentage of cut.
Okay. All right, Mr. Srinivasan, thank you so much for joining us and detailing what the demand ahead is looking like. That's the word coming in from eClerks. With that, we'll slip into a short break now. When we return, Budget 2023 has ended the tax advantage in market-linked debentures. What does it mean and what will the impact be on something like Anand Rathi Wealth Management? We'll be joined by Feroz Aziz to discuss more. Stay tuned. Well, in the recent budget, it was announced that from FY24, returns from listed MLDs, that is market-linked debentures, will be taxed as short-term capital gains versus long-term capital gains, and also that it will be taxed at the investor's slab versus 10% currently. And it is analyzed that maybe it will take away the product's appeal, that is the market-linked debentures. Whether that will happen or not, let's discuss this, what the impact could be on distributors of such financial products. We are now joined by Feroz Aziz, the Deputy Deputy CEO at Anand Rathi Wealth, to take some questions. Feroz, good morning. Thank you so much for joining us. As we pointed out, the general consensus is that yes, it could take away the attractive fundamentals of MLDs, so to say. What is your take on this? And since it is a big chunk of your revenues as well, how much of a hit it could be?
Hi, Sonal. To my mind, first, it's very important to decipher the new section which has been put in. 50AA is what it's called. It says MLDs which have the full principal component in debt and the return comes from derivative will be taxed at short-term capital gain. This is what it says. The full component, principal component should be debt and the return component should be derivative. Then it will be classified as MLD or the SEBI definition. So by prima facie, to our mind, the debentures which are unlisted are not covered. Point one, because the principal is not protected. That's one. Second, coming to your pointed question, will the attractiveness for listed MLDs come down? To my mind, it should not come down dramatically, because if 10% is there, that was an unfair extra credit which didn't exist to any debt instrument and existed for MLDs, and that had to go away. That's why Anand Rathi Wealth Limited never gave any listed MLDs in the lieu of that 10% attractive tax rate like equity. That's point. Why would it not go away is because there's several silver linings in this announcement, which I don't think people have dwelled on. One is it has not been categorized as interest income, but it is categorized as short-term capital gain. If there is interest income, the income goes into the head of income from other sources. If it goes into short-term capital gain, Section 73 helps you set it off with several other capital losses the rest of the constituents of the portfolio give. That's the one silver lining. The second silver lining is Minister Madam has also said that you don't have to actually now sell it. Even if you mature it with the issuer, you will still get capital gain, which I think is a very, very big gift, because there is no other debenture which you surrender to the issuer and you don't get a TDS and an interest income. It is now a person does not have to sell before maturity, which was a big pain for an MLD holder. That's point 4. Point 5, Sonal, last one. I probably let me stop here and have some more questions from you instead.
Feroz, you've clearly detailed out the analysis. So just simply put, for our investor in Anand Rathi, what could the impact be?
For the investor in Anand Rathi, the impact could be negligible or nil. Even if unlisted debentures were covered. Unlisted debentures are not covered, that's the prima facie opinion. That's point 1. Point 2, if unlisted debentures are covered, also it's a very, very good thing, because with the new tax regime, a family of 4 has several files where there is no surcharge. Even today, if you pay 30 lakh rupees of tax income, the tax is not more than 6 lakhs, which is 20%. So this 39% taxation, which I read on a few print articles, is very hypothetical. 39% doesn't exist to even 500 people in India. So that 39 doesn't exist. At worst, it is 30%. If there are, if a MLD holder gifts this debenture to his major child, who does not have other incomes, then the taxation is as little as 15-16%, even on 2 crore investments. So I personally think it is Nirmala Sitharaman has forced people to think and again come on the driver's seat, just like the second tax regime which has been introduced.
All right, Gauda, that clarification is very useful. Feroz, just one quick point. If you could tell us what is the current split that you have between MLDs and mutual funds, if you could just help us with that.
So the mutual funds, equity mutual funds of our total assets is 48%. 12% is debt mutual funds. 29% is MLD.
And you're not planning any kind of change in this mix that you just broke up for us right now?
No, we don't want to make any changes, because the effective tax rate, even if unlisted MLDs were counted for the full portfolio which we run, is 14% tax, effective tax rate. And in fact, it becomes a huge business opportunity for us, because we are now going to be starting a separate tax vertical, just like we have the estate planning division and the ring fencing division. We're going to start taxation services, because when it comes to tax, the full portfolio has to be considered, not just one individual constituents, because short-term capital gains are under one head. So point is, Anand Rathi Wealth Limited wants to use this huge opportunity to holistically advise people or at least give opinion on the taxation side, especially to 10 crore plus clients. We will start immediately. And that will bring in huge penetration into people's overall wallets here.
Well, Firoz, you would have loved to chat more. We're out of time, but thank you so much for taking out the time to explain this change that has been announced in the budget. So that's the word coming in from Anand Rathi Wealth. No impact, so to say, for the investors for now. But important flashes at the bottom of your screen. LIC is going to conduct a call with the Adani Group to understand their strategy. They are a long-term investor and they follow the investment strategy going forward as well. So they need to take up some more details. We'll get you more details on this one. For now, it's time for a short break. When we return, we'll get chatting with Varun Lochab of HDFC Securities to discuss the market fundamentals and more. Welcome back. You're tuned into Trading Hour on CNBC-TV18. And as promised, we are now joined by Varun Lochab, who's the head of institutional research at HDFC Securities, to discuss some market fundamentals. Varun, good morning. Thank you so much for joining us. Well, it's been interesting last 1 week as far as the market moves are concerned. We had the budget, earnings, and the big Adani group movement that we've been tracking as well. What are you making of the markets right now? And because of whatever we have been talking about as far as the Adani group is concerned, anything that you make in terms of exposure or risk, so to say, for the markets?
I think markets have been largely range bound. If you look at the Nifty, it's been trading in that 400, 500 point range. And from the start of the year, we are down 2-3%, which is again on fairly expected lines. Our expectation for the year was that we'll deliver somewhere between +5 and -10% kind of returns, and other global markets were looking far more attractive, and that's why they have started off on a strong wicket in the beginning of the year. So money is definitely flowing to other markets and other sectors like tech sector in US, which was really beaten down. So I think that country rotation, sector rotation, that seems to be playing out in markets overall. The good part is, I think if you look at the fundamentals, earnings, they seem to be largely on expected lines. There have been no big, misses at an aggregate index, earnings level in Q3 so far. We are still in the middle of the earnings season, but given some of the heavyweights have delivered good earnings, banks we have seen earning upgrades. IT, we have not seen downgrades like earlier quarters. And some of the other big ones like Tata Motors and even oil marketing companies are okay. I don't think there is a big risk to earning estimate. What is happening is valuations are cooling off from elevated levels, which is, I think, very healthy. And if we just do some more consolidation in this range for next 3 to 6 months in terms of broad 16.5 to 18,000 kind of a range, then that will set us up for for returns in the subsequent period. So net the market keeps grappling with some issue or the other. Right now, because of this Adani issue, we don't see too much impact on the broader financial sector or overall market earnings per se. So we are not overly worried out there.
Varun, but what you're basically saying is that markets are building a base and they are likely to do so for some more time, which sets us up well for the future. Any stocks in the broader markets where we've seen a bigger fall as screaming buys, where valuations are very, very attractive?
So, see, frankly, most of the market, we were struggling to find value in any part of the market, for last 2-3 months, because everything was either fairly priced or slightly, overpriced. I think financials is one where probably there is, right kind of valuation. They are fairly priced, given the fact that we are sitting at peak earnings, and even out there, probably things will go down a little bit in terms of sequentially, in terms of earnings as NIM starts to come down. But overall, financials is a good pocket. I think both banks and select NBFCs are looking okay. They can at least hold on to valuations and grow in line with their earnings, which will again be in mid-teens for the next financial year. Infra industrials, again, given the fact that the budget remains on track in terms of capital formation in the economy. The emphasis is very clear that the government priority is on capital formation. So some of the industrials and infra cap goods stocks can be looked at. But again, no, I don't think that they are in deep value zone. They are either fairly priced or slightly overpriced. So you have to be selective. I think it's a market where you have to be very selective, but there are still some bottom up opportunities across most sectors. Like in infra industrials, we have L&T, Cummins as our top picks. In financials, it's ICICI Bank, Axis, SBI. So there are stocks which you can buy from most of the sectors, and the good part is that you have to keep a well diversified portfolio. That's why even while we are not super positive on IT as of now, but we do have a reasonable part of our model portfolio in IT, given it's a high quality sector. So stocks like Infosys, Persistent, we continue to like them despite some headwinds which might still be there around the corner for IT. But I think as long as you're keeping a well diversified portfolio and doing bottom up stock selection on basis of earnings trajectory and valuations, I think we should be fine from a 12-month perspective.
All right, that point is well taken, that you perhaps have to look at it individually on a stock-to-stock basis rather than just take a call on the entire sector. Varun, we leave it at that today. We would have loved to chat some more, but we'll save that for another day. An important story coming in for now. Sources are telling CNBC-TV18 that LIC will be scheduling a call with the management of Adani Group to really understand the company's strategy. Note that this comes amid, of course, this massive sell-off that we've been seeing in the shares. So Yash is joining us with all of the details. Yash, of course, LIC holds a large chunk there, so they want a call now.
Well, that's correct, Pavitra. So just to put this in context, it was on January 30th when we had spoken to LIC last. They had also issued a public statement back then. And the indication at that time was that they are long-term investors. And in the fall till then, which was till 30th January, they hadn't sold any shares of Adani Group stocks. It's been about 6-7 days since then. Adani Group stocks have sold off much more ferociously post that, and today again we've been able to reconnect with the sources in Life Insurance Corporation of India, and we understand that the stand for LIC remains the same. They haven't sold any of their holdings in Adani Group stocks despite the ferocious fall which has come in about the last 6 to 7 trading sessions. What we also understand from our sources is that LIC management is expected to schedule a call with Adani's top management sometime next week. That will be to understand their strategy on various aspects, doing rounds about business, about stock price, about various other things as far as the group and the different businesses are concerned. The exposure for LIC as far as the Adani Group is concerned is small. That's a disclaimer. About 0.97% of the total AUM and 8% of their equity AUM.
Thank you very much for that. But the problem is that LIC's holding itself in Adani stocks would have fallen significantly. Our colleague is telling us that the Adani Group's market capitalization prior to the report coming out was 19.2 lakh crore. And this has come down to 9.5 lakh crores. More than half of the market capitalization has been erased in the rout that we've seen over the last 1 week. More than that now. Get into a break. On the other side, we'll invite Saurabh Mittal, MD and CEO of Greenlam Industries, to join in to talk about this.
Welcome back. You're still tuned into Trading Hour. Let's get you another corporate conversation now. Greenlam Industries is on our radar. The company posted a 12% rise in its revenue. But on the margin front, we have seen some softness on a year-over-year basis. Laminate volumes grew by 7%, while the veneer volumes declined sharply. So we'll talk more about all of this and also discuss the outlook going forward. We have Saurabh Mittal, who's MD and CEO of Greenlam Industries, who joins us now. Mr. Mittal, thanks a lot for joining us. This is Pavitra. And, I want to begin by asking you about the revenues itself, because we're done with 9 months of the year. And for that period, we've seen revenues of around 20%. I know you did give us a guidance earlier of 20 to 25%, but that's a little bit of a broad range. Would you narrow it down for us? Where do you see it now for the full year?
So I think 9 months, as you are aware, we are at about 20% growth.
Yeah.
And so I think we should be closing at around 20% plus minus, percent here or there. So I think that should be where the year will close at in terms of revenue growth for financial year 23.
So this would be at the lower end of your guidance, right? Can you tell us if what kind of demand situation you're seeing then? Has that sort of changed considerably from the beginning of the year?
So Q3 is typically slow too, and October, November was slow with holidays and just generally building material demand was slow. But I think despite the demand situation, we did well, I think, in the last quarter. And so I think the demand situation is nothing very exuberant or very low. So really, I think we have to continue to work towards gaining more market share, which we are doing. Several of our export markets, which were under stress, have also, to some extent, normalized because they have those currency problems. So several of those markets have also come back to a certain normalcy. And we've had export growth also happening in Q3. So I think as we move ahead, we should be able to achieve our planned numbers in terms of revenue growth.
Okay, and what about margins? You have reported margins of 10.6%. That's 9 months. By when you will get back to margins between 11.5% to 12.5%? Because freight rates have come down, but generally other raw material prices still still on the higher levels. What is the margin outlook here?
Right. So in Q3, gross margins have gone up. We've actually had about 48% plus gross margins. So on the EBITDA side, we've had high expenses because the factory we bought in Gujarat has not come to a full production. We had some additional costs because of that. We've had higher marketing costs in Q3 to sustain brand building exercises. We've also had some additional manpower costs because we're building teams for the new product launches, which will happen in the next financial year. So actually margins have improved. If you see the gross margin have gone to 48% plus, it's not showing up on the EBITDA. So as we move ahead, raw material costs have normalized. They still fluctuate a bit. So it's not as if they've gone very low, but it's more or less within a certain band. So I think as we move ahead, we should see improved margins.
So what could the margins look like in Q4, the extent of quarter-on-quarter margin improvement? And also if you could talk about the exports. You said certain export markets have opened up and things have improved. Which ones are those and what could your export revenues look like?
So I can't give you like an exact number where the margins will go, but clearly with gross margins improving and if top line improves, more in Q4, we will see improved margins in Q4. As far as exports are concerned, we had markets of Sri Lanka, Bangladesh, Nepal, Egypt, some more African markets which had challenges of currency. They couldn't open, letter of credits, they couldn't make payments on time. So I think that's all by and large behind us now, and they're normalizing to some extent. So those losses in those markets have been recouped, and that'll probably bring more revenues for us, going ahead.
Okay, just one final question. I was mentioning earlier that, the veneer volumes declined sharply. It was around 22% decline in the volumes. And this has been a loss-making part of the business for a while now, right? So can you tell us what is the outlook? Do you expect this to turn profitable in the near future?
So clearly we expect it to turn profitable. And if you see the value sales have gone up, but we've had some higher raw material costs in the veneer business. We passed on increases to the market in Q3. And that's so that we had some challenges on the veneer business volume, while the flooring and door business have done better. So I think we just need, and the losses are not very significant. It just needs a little bit of improvement on the revenue side, and we could see, margins coming in. So we are constantly working towards improving that part of the business too.
Okay, all right, Mr. Mittal, thank you so much for joining us today and detailing those Q3 numbers for us. That's the word coming in from Green Lamb. But with that, it's a wrap on this edition of Trading Hour. Stay tuned, all the market action will come up next on Halftime Report.